Hello, everyone, and welcome to the second day of live streaming of the Fintech and Digital Banking Innovation Conference, Blockchain and Crypto Finance, which is part of African Digital Week. Yesterday, we have very interesting and very engaging day and panels, thanks to our keynote speakers and, of course, our great audience. Today, also, we're going to moderate two different panels. I want to especially thanks to our keynote sponsor, TimeDix, our diamond sponsor, Tendric, which is leading digital marketing and e-commerce agency, and our platinum sponsors, Trinity Technologies and EM Gurush. Of course, I want to thank the whole Digital4 team and our worldwide volunteers team. Thank you all for your support. Now, we're going to start with our first panel for today, which is regulation in FinTech and RegTech. The moderator of the panel will be Dr. Babatunde Obrimah. Dr. Babatunde Obrimah is a Chief Operating Officer in the Fintech Association of Nigeria. He's going to share with you some more information about himself and about the other panelists. Babatunde, you're on.
Thank you, Angelova. Good morning, everybody, and welcome to today's session. We have 4 speakers. I'll be starting the work of Fintech Association. We have presently about 219 members cutting across the economy. We're driven by 3 major objectives: to connect everyone within the fintech ecosystem, to accelerate technological growth, and there are progressive regulatory reforms in Nigeria that support innovation and creativity. And in doing that, we do all sorts of things, activities to my own topic for today, which is self-regulation and the future of fintech. So how does industry associations support regulation, and how does that affect the future of fintech? It's a short presentation. And then I have my colleagues who will be speaking to Berku Mentesoglu from Germany. She will introduce herself when it's time for her to make her presentation. We have Cyril Okoroge, who is from RegTech Africa. He will introduce himself when it's time for his presentation and what he does. And then we have Moses Onitilo, who is from Jambro, UK. He will also introduce himself and what he does when it's time for his presentation. And then after that, we'll have a Q&A session, which will be panel-like and Q&A from the audience based on the various presentations that have been made. So thank you very much for joining us this morning. I'll go ahead and share my screen. We'll start with my own presentation. Okay. So basically, my outline will be looking at industry associations, regulation and regulators, self-regulation, fintech, Nigeria as a case study, collaboration, and then conclusion. So when we look at global fintech associations, this map just shows not all the associations, but some major associations. So you have the Singapore Fintech Association, you have the Hong Kong, you have MENA in UAE, you have the Canadian Fintech Association, the European Fintech Association, the Portuguese, the Fintech Association of Nigeria. And what do all these associations do, or what is common to all of them? And I think what is common to all of them speaks to what we do in Nigeria, which is basically to connect, being able to bring everybody together, to share, to network, share ideas, build solutions, solve problems. I think that's the beauty of fintech. Fintech is always looking for problems to solve. And then to accelerate technological growth, I mean, in various ways. For example, this year we'll be starting a program called the DigiStuds. How do we get 100,000 students across Nigerian universities to understand coding, to understand blockchain, to understand entrepreneurship skills, irrespective of the program that you do? And that way we start to prepare people for the future of work. So if the Nigerian educational system is not ready, we can help them. And then advocates which is how do we ensure that there are progressive regulatory reforms? And I think that cuts across everybody. And I'll just show you an interesting slide. I'm taking about some of the fintech associations and see what they do. And what is common to all of us is the fact that fintech events, which speaks to connecting, also membership is also about connecting and accelerating. Connecting a network is common to all. And then policy advocacy is common to all. So the issue of regulation is something that is common to all industry associations. And then, so the question is, I mean, and for me, I've always, I believe in regulation. The financial systems are stable as regulations that govern it. But the questions that we now need to ask is, what should be regulated? How should it be regulated? When should regulation kick in, especially with fintech-related solutions? If we look at regulators generally, they are concerned about three things: economic stability of products, and how the products affect economic stability; consumer protection, to ensure that you are not there to defraud consumers or cheat consumers in terms of pricing or what have you. Also, investor protection, how we sure that people who are invested will not lose their funds. So if regulators are concerned about these three major issues, and then so as industry associations, we should be able to guide ourselves, to self-regulate ourselves, to ensure that those three concerns of regulators are looked into. Because there's no doubt that technology is always ahead of regulation. And because of that, regulators are always apprehensive as to, oh, this, I say they see the fintech guys as the new kids on the block. What are these new kids up to now? So, I mean, we need to also help regulators in that respect. So what should be regulated? You can't regulate technology, but you can regulate products and how these products affect the market, how it affects consumers and investors. How should it be regulated? That's a big issue because fintechs don't want to be regulated like banks. They want more freedom in the way they are regulated. So how do regulators, how can fintechs help regulators to ensure that they regulate what is really, really important? So in doing that, I mean, if you look at the definition of self-regulatory organization, is one that has the power to set industry standards and regulations through its own efforts. Industries can band together and start their own SROs, which allows them to maintain competitiveness and safety concerns. So why should we regulate? I think the main purpose of regulation is actually standardization. I mean, how do you ensure that we're all as industry helping? Once we can standardize, I think it makes the work of the regulators easier to be able to work with innovators, you know, and to ensure that regulations don't stifle creativity, they do not stifle innovation. In Nigeria, we're started with standardization, and one of the things we're starting with is the Digital Lending Group, developing a standardization document, which we share with the regulators and see how that influences regulation for that sector of the ecosystem. So looking at Nigeria as a case study, what have we done? One of the things we've done is to set up a regulator forum. The regulator means regulators and innovators. It's a forum which we set up last year where all the regulatory agencies are represented in the ecosystem. With some of the things we've been able to achieve over time, one of them is working with the SEC to develop a fintech roadmap for the capital market. We've also, out of that document has come the regulations for blockchain and digital assets. Out of that has come also the framework for crowdfunding. We've also worked with the central bank with our inputs in the Banking and Other Financial Institutions Act, the BOFIA, which is passed into law by the National Assembly. We also had inputs in the sandbox of the central bank. Same with the Payment Systems Vision 2030 document of the central bank. We're also represented on the Presidential Committee for the African Free Trade Agreement, and also for the Nigerian data protection regulation document. So because of the fact that we need to self-regulate ourselves and our members, we've been able to play roles in all these various documents to ensure that the industry grows. So, but in doing this, one thing we've also realized is that we cannot operate as a silo. And if anything we should do in Africa today is to take out the silo mentality and look at collaboration. There are other associations that also support various industries that we have associated with the Central, the Chartered Institute of Bankers, the Association of Stockbrokers, Blockchain User Group in Nigeria. So all the other associations, we've reached out to them to join us as professional bodies so that we can speak with one voice for the ecosystem. And we see that also happening with other industry associations, the Singapore Fintech Association, working with startups, and ensuring that they act as gateway to new markets across Southern Asia. I believe that as an industry association, to be effective, we must be able to bring together innovators, investors, and regulators to interact, to build networks, and to learn from each other. As they say, all of us is stronger and better than just one of us. And then I think that for the future of fintech, I'm just going to borrow from Chris Skinner's the 5 P's relevant to the fintech ecosystem, that as fintechs must have purpose. I mean, what does the ecosystem stand for? We must be able to define our processes. Are we structured in end-to-end processes that are automated as possible? What are the platforms that we use? Are there interoperability? That is, comes to also taking off the silo mentality. Can we deliver value using best-in-class technologies? And then the people are extremely important. I mean, we should continue to strive to help customers, employees, regulators to do what they need to do and deliver value. And then more importantly, how do we position ourselves? I mean, how we position for relevance? I think that's extremely important for the future of fintech and how industry associations work together with fintechs and various industry players to achieve growth within the fintech ecosystem. So I started talking briefly about the association. I was just going to round up. For Nigeria, we have 20 different sectors represented in our association, and these are the various groups that make it up: payment, lending, banking, startups, consulting, mobile money, blockchain, insurance, professionals and students, legal. So all these work together. And for us, how do we as an industry association work with each of these groups to develop standards to make sure that we work with regulators and grow the ecosystem? So thank you. That will be my short presentation. And if you wish to contact us at Fintech Association of Nigeria, you can do this through this contact. Thank you very much. I'll go now to Berku to start our presentation.
Thank you very much, Babatunde. Let me share my screen. Great, thank you so much. I think Babatunde's presentation was very lively, and I hope you will find mine as lively and as interesting as this. In this presentation, first, I'd like to go through the overview of the global legal entity identifier system. And then I will talk about LEI's role in facilitating faster digital onboarding for corporates and how it can help to financial institutions and fintech community. And lastly, GLIFE's engagement in Africa. First, let's start with the global LEI system and GLIFE, who is Global Legal Entity Identifier Foundation. So basically, we are a not-for-profit Swiss foundation, and we are founded by the Financial Stability Board in 2014. We are overseen by 71 regulators from 50 different countries. So it's quite diverse structure who is overseeing the GLIFE. And we have 16 independent directors. As GLIFE, we are not issuing the legal entity identifier, but instead our partners, our accredited partners are issuing LEIs, and we have 39 LEI issuing organizations, LOUs for the time being, and it's growing. Up to date, we issued in global LEI system, there are more than 1.8 million LEIs, and it's growing also due to regulations and voluntary uptake of the LEI. So if we introduce the global LEI system, first how it got created, it was just right after the financial crisis of 2008. And in 2011, the G20 leaders asked Financial Stability Board to create of a global legal entity identifier, which uniquely identifies parties of financial transactions, so the interconnectedness between different entities on a global basis can be tracked and understood. Global LEI system has 3 layers. In the middle, you see our foundation, GLIFE, Global Legal Entity Identifier Foundation. Above us, as I mentioned, we have Regulatory Oversight Committee, and also we have local operating units who are issuing LEIs to legal entities. So what is this LEI, the Legal Entity Identifier? Basically, it's a 20-digit alphanumeric machine-readable code, and it's a lifelong code owned by the respective legal entity. It has 2 pieces of information. One is basic business card information, which is high quality and standardized data. And it also includes corporate structure, direct and ultimate parent information. And it's an ISO standard, ISO 17442 standard. Here you see an example of Nestle, and when you go to GLIFE's webpage, you can see and search any entity you want. Our database is free and open and publicly available. And here you see the distribution of the LEIs across different jurisdictions. Europe particularly makes 66% of the LEIs worldwide issued. Then it's followed by the North America. In Africa, we have the LEIs in Africa make less than 1% of total LEIs issued so far. But it's, as you will see in this slide, it's very much dependent on the regulatory framework. And you see here that Europe stands out in terms of the regulations and requirements which mandates the LEI in supervisory and regulatory frameworks. So that's why you see that how the LEI is also, LEI numbers are reflected in par with the regulations. And after Europe, we have North America, Asia Pacific, and then Africa and Middle East. I'd like to highlight a few some documents from regional and international organizations about the usefulness of the LEI and wider use of the LEI, calls for wider use of the LEI. The first one is European Systemic Risk Board's recommendation on identifying all legal entities in the EU with the LEI, so that all supervisory and regulatory frameworks can be better harmonized. And second, Financial Stability Board's stage 1, 2, 3 reports for enhancing cross-border payments. Financial Stability Board says that if the LEI is used as a unique digital identifier in cross-border payment messages, then all entities can be identified uniquely so that cross-border payments can be more transparent, inclusive, and efficient. Basel Committee on Banking Supervision Guidelines on AML also asks regulatory bodies and financial intelligence units to use LEI on a more standardized basis. For the time being, it is rather a supplementary information. But the Basel Committee says that if the LEI growth is increasing by time, then it can be a mandatory field for legal entities. And lastly, European Banking Authority suggests the European Commission to use the LEI as a digital unique identifier in suspicion activity reports and all AML supervisory frameworks. So why did I explain all this regulatory framework? Because it's very much linked with our RegTech and regulatory and subtech discussions today and in general. So as we all know, regulatory requirements keep increasing since the last financial crisis in 2008. Actually, the LEI itself was also born as a regulatory requirement at the aftermath of this financial crisis. We also know that since the financial crisis of 2008, there was a 500% increase in regulatory changes in developed markets. And of course, it means a lot of costs and labor-intensive processes for firms. And digital technologies, let's say regulatory technologies, are trying to offer significant cost savings for firms. But we see that still there is a room for bridging the gap between RegTech and subtech frameworks. So if we move to the next slide, we will see that digitization, I think we can all agree in this panel discussion and with our audience that digitization works best to the extent it relies on standardized data. Standardization of data is crucial to prevent delays in data processing and create a more automated analysis. So why we think that the LEI is a perfect fit? Because it's a machine-readable global standard for unique entity identification. Imagine a legal entity is reporting both a supervisor authority in Europe and also, let's say, in Nigeria. Then how to link this entity in an automated basis if you do not use a unique identifier. The LEI can really bridge the gaps between RegTech and SupTech frameworks. So while companies, of course, have their national business registry IDs in the country that they register in, LEI is the international standard, let's say the passport for cross-border transactions and data sharing. Business registration standards, of course, differ according to the country that they operate in, but the LEI format is structured and the same across globe. So let me a little bit talk about also LEI's role in facilitating faster digital onboarding for corporates. I'll just start first with how the entity identification is done today and what are the pitfalls. According to a research we did with a UK research agency, we found out that on average 4 different identifiers are used to onboard a business, to identify a business. And for normal to more complex clients, it takes 6 to 7 weeks to onboard a new client. And most, I think, problematic part is that still financial institutions, despite using all these different identifiers, they say that the reliability of reference data of their counterparty is still a problem for at least 57% of them. So what are the impact of using different identifiers? Inconsistent information, drain on resources because it requires a lot of manual reconciliation, lack of transparency and certainty about the entity data, and data is proprietary, siloed, and non-standardized. So we are saying that if the LEI instead is used as a bridge linking multiple idea systems on a global scale, first, it can create a really high data quality in terms of the reference data information. It is connected to other identifiers such as business identifier code or ISIN code. So that means you can have the linkage between different identifiers. And it can be basically the Esperanto common language complementing and linking existing identification systems. Moreover, as it's a digital and machine-readable standard, it can be used in different digital solutions which are evolving, such as digital certificates or verifiable credentials. So that's why we are suggesting and we are creating a new framework for financial institutions to better engage with the global LEI system on a more voluntary basis, so that the LEI is not only a regulatory requirement for financial institutions. So the validation agent framework is a new operational model we developed at the global LEI system, which allows financial institutions to obtain and maintain legal entity identifiers for their clients as a byproduct of their existing client identification and KYC procedures. Because financial institutions will anyways need to verify the legal name, authorized signatory, business registry information, legal and headquarter address, and corporate structure of the entity before they onboard a new client. So we are saying that these data fields are really matching with the ones that are required for identifying and for verifying the legal entity reference data in the global LEI system. So why not using what you're already verifying? So this is how it looks like in terms of a process flow. Imagine a customer wants to open an account in a financial institution, and financial institution can use free and publicly available Glyph API to see if the customer already has an LEI or not. If the customer has an LEI, that's perfect. The financial institution can pre-populate customer data. Customer can review all the information, and if it's correct, they can move, they can put a checkbox and they can move for the next step. So this is particularly a quite good enhancement for digital onboarding solutions for corporates. But what if the customer does not have an LEI yet? And at this stage, the financial institution as validation agent concept comes into the picture, and financial institution as part of their client identification and verification process creates the LEI in cooperation with an LEI issuing organization at the end. And then this LEI, the data created by the financial institution, then can be consumed by the financial institution B and C and D as this entity operates in different jurisdictions or works with different financial institutions. So what is the advantage for the financial institution? It can reduce onboarding costs 10 to 15% according to a study of McKinsey. It can improve data quality and transparency. It can reduce risk of AML penalties because financial institutions now will be knowing precisely whom they are doing business with. And it will result, of course, efficient onboarding and better client experience. And financial institution would be equipping its client with a lifelong global digital unique identity. So lastly, I'd like to say a few words about our engagement in Africa. I think we all would agree that de-risking and trade finance gap is increasing in Africa, like in many other jurisdictions. But for instance, for Africa, we can say that rejection for SME trade finance has doubled in the last 5 years. We think that new KYC requirements, new AML regulations deter particularly correspondent banks to participate trade finance for new clients, as the identification of new clients and KYC checks is considered costly for many banks. So we suggest that the LEI can help to overcome the information asymmetry that exists today and reduce client identification costs for financial institutions. For being able to understand the roots of the identification problem in cooperation with German development agency GIZ and Making Finance Work for Africa initiative, a survey was circulated to African entities. And we found out that actually the LEI can help both companies, financial institutions, and for financial authorities to create a more transparent and better KYC and AML scheme so that they can enjoy the benefits that the LEI presents. For the time being, we are having a project in Africa with an institution in Zimbabwe, and we are testing the applicability of the validation agent role that I just shared with you all. At the end of the project, the financial institution will equip a number of SME clients and some corporate clients with the LEI. And if the project is successful, we would like to roll out this model in a wider scale. And I would like to highlight that the model is not specific to Africa. Our first validation agent was JP Morgan Chase, a well-known global bank who piloted this validation agent model with us in 2020. But we believe that the validation agent model will bring a lot of benefits both to the entity clients, as they will be able to access to cross-border payments, credit facilities without any identity restrictions, and also for financial institutions because it can really reduce compliance costs fast, and it can increase fast and secure digital onboarding opportunities and better risk management and correspondent banking relationship with other global financial institutions. I'd like to stop here, and I hope I didn't talk more than I was supposed to talk, and I will be happy to respond to any questions during our discussion. Thank you.
Yeah, thanks, Barker. So we'll go straight to Cyril. So Cyril, introduce yourself, what you do, and then your presentation. Thank you. So Cyril, you're muted.
Hello?
Yeah, great. Yeah.
Oh, okay, sorry about that. Yeah, my name is Cyril Okorigwe. I'm the CEO of RegTech Africa. RegTech Africa is an emergent global digital tech media platform with a niche focus on regulatory technology innovation in Africa and across around the world. We are a niche information ecosystem service hub with a key focus on innovation, business technology, regulation, payments, entrepreneurship, economic development, sustainability, and much more. We leverage our extensive partner resources to provide strategic and knowledge management support to industry stakeholders as we strive to complement regulators to shape conversations and advocate on key change imperatives in a collaborative manner by raising the bar through the way we conduct our engagements. I'll go ahead now and share my slide. Okay, sorry, I was having some challenge. Yeah. I guess my slide is on.
Yes, it is. Yeah.
Okay. So I'll be talking about RegTech in Africa, adoption opportunities and challenges. Like has been said, RegTech is, generally speaking, a subsector of the fintech ecosystem, but it's a special subsector because of the importance of regulation, and its impact, across the entire value chain. So the first slide here just gives that pictorial place of the different engagements. Now across the world, right? Different governments and regulatory initiatives has been put forward in support of regulating the fintech activities, like has been captured extensively by Dr. Babatunde, right? A lot of initiatives have been is ongoing and have been ongoing across the globe, ranging from the introduction of regulatory sandboxes, regulations that also cut across self-regulation, coming together of associations, for the purpose of, addressing and taking care of those basic concerns of the regulators. So regulators are basically undertaking various approaches to provide regulatory oversight with the aim of protecting consumer, at the same time, making efforts not to deter innovation, which is quite key. Looking at the trend, at the global trend, there are key things we see that cut across as far as regulation is concerned. The first one there talks about balancing innovation and regulation. This is done basically by promoting fintech collaboration and existing customer confidence. We also see a lot of efforts going into industry inputs, where you have an inclusive approach rather than working in silos. Here you have a more of an ecosystem approach to the issues. We've also seen the two different types of mindset that exist as far as regulatory approach is concerned. One is the progressive mindset, and the other is the restrictive mindset. The role of regulatory sandbox has also become very, very key and central in the discussion now, basically because the regulatory sandbox provides the flexibility required, in experimentation while minimizing risks. And this provides a lot of benefits, advantages to both the regulator, the tech companies, the startups, and even the consumers themselves. We've also seen cases of flexible policies, where policies are looked at not necessarily from the rule side of it, but from the intent, right? So rather than applying policies based on rules, you look at the principle behind the policy. Of course, RegTech takes a major position there, using technology to reduce the cost, complexity, and time in regulatory reporting. Of course, as also captured by Dr. Babatunde, global or international cooperation, collaboration of all sorts, is becoming the order of the day. And these are some of the trends across board. Now, coming to Africa, we see, again, an outlook that's, it looks bright, but again, there are a lot of factors to be considered here. The regulatory environment is certainly growing, no doubt about it, in Africa. However, there are general identifiable trends in the regulatory environment which may allow stipulations regarding the current and future state in Africa fintech landscape. The regulations are aimed, most importantly, the regulations are aimed to balance the growth of the sector without providing appropriate protection for consumers. In few other countries, like specifically Uganda, Tanzania, especially in the East African countries, the regulators are more receptive in terms of their openness, to fintech development, and they see fintechs as an important driver for financial inclusion. However, generally what we see currently is that a few countries such as South Africa, Kenya, Ghana, Uganda have more advanced data regulation framework. So these are basically some of the things you see around different countries in Africa. Clearly, again, from a driver's perspective, why the fintech, right, is basically triggered and driven in Africa by the vibrant demography, the high increase in the number of mobile phone access, the poor level of financial inclusion, the limited infrastructure, and of course, the lack of options for alternative data for peer-to-peer transactions. RegTech, on the other hand, is being driven by increasing regulatory requirements, increasing cost, rising number for faster transactions, regulatory sandbox approach, and of course, low entry barriers with software as a service. So these are some of the things that we see driving regulation in Africa. What are the potentials? From what we see, the potentials are huge. And I'm going to share some pictures that, speaks to this. They are huge, but however, we know that across the continents, as you transverse from one end to the other, there are key things that pose some serious challenges. And some of these challenges actually range from the rules that exist across different countries and the different culture, some are even cultural, right? So a primary purpose of implementing RegTech solutions is to mitigate regulatory risk, which was a driving force for their widespread adoption by financial institutions following the global crisis. Of course, the 2008 global crisis played a very critical role to the surge of RegTech solutions and the need to have RegTech play a key role in the financial system. The category has continued to grow over the past decade as more sectors see the utility of implementing RegTech solutions, so much so that, in fact, there was a 600% increase in global investment during a 5-year period from 2014 to 2019, and a 103% increase year on year in 2019 alone. So opportunities of RegTech, of course, has been further boosted by the talk of having a common region in Africa for purpose of trade. And that we are hoping is actually going to galvanize this even the more. Now, looking at this basically looks at the investments that have come into the different ecosystem within Africa in support of fintech startups, of which the RegTech is part of it. Now, looking at this, and some of the other slides I'm going to share, one thing stands out, and that is that the big four, which is likely Egypt, Africa, Nigeria, Kenya, and South Africa, represent a third of Africa's population and half of its GDP. However, they attract 3/4 of the startup deals of over $500,000 and $6 out of $7 of funding raised through these deals. So that speaks volume. This shows another perspective of the previous photo, which looks now at the deals, rather the number of rounds of deals that came in. Again, you find out that the major 4 blocks remain very outstanding. And this tells clearly that there's a whole lot of interest and a whole lot of opportunities as far as fintech investment in Africa is concerned. Now, of course, this captured the initial summary showing the 4 key blocks, 4 key countries in terms of their GDP share, which is 51%, in terms of their population, which is 31%, in terms of share of the startup fund rounds, which is 74%, and in terms of the share of funding raised, right, which is over 80%. So that captures it. So clearly, in terms of opportunities, it is clear that there's huge potential for opportunities in Africa. But looking at this slide, which now breaks this down into sectors, you will now see that in terms of the portion for RegTech, out of these big, huge opportunities that we saw, you'll see that it is very small compared to the others. Apart from South Africa, where you're able to see a bit of that, in the other country, Nigeria and Kenya, the percentage is almost insignificant. That I mean, it's not visible, right? So that tells that yes, even in the midst of the huge opportunities, there's a whole lot that has to be done, right, to increase the adoption of RegTech as a whole. And looking at the broad categorization of the sectors, the sectoral areas that the RegTech itself covers, it plays a key role in regulatory reporting, risk management, identity management and control, compliance, KYC and fraud management, and transaction monitoring. So these are some of the key areas where the use of RegTech applies. Globally, if you look at this again, taking some of the regulatory maturity levels that we see across the globe, you'll find out that in Africa, apart from Nigeria and a few other countries, where you have some level of activity as far as sandbox maturity is concerned and usage, right? The other part of Africa is pretty much, there's really not so much of activity in those other parts. Taking this order, again, this looks at another technology which is very, very important in regulatory technology and the use of regulation to enhance technology, which is open banking system. Looking at the maturity level again across the globe, you find out that again in Africa there's a whole lot more that needs to be done, right? So this clearly shows where we stand in Africa, and that a lot more needs to be done to get Africa to occupy a similar position to what you have in some of the other countries where this has actually gotten to a more advanced level. There are some factors, however, that needs to be considered really when we look at the impacts of regulation across and the use of regulatory technology. One of those factors is the legal mandate. The other one is the market conditions, the stakeholder ecosystem, the capacity of the resources, and the maturity of the fintech segment within the country. So these different categorization and factors actually apply to and affect different countries in Africa differently. And these are some of the reasons, especially when you look at the different level of maturity that exists within Africa. These are some of the things that are responsible for these differences. From an opportunity standpoint, we see that there are 4 key areas where RegTech can be leveraged for the advantage of growth in Africa. The key one there is, the first one there is building transactional trust. As we know, trust is key in everything that we do. And in fact, the whole essence of regulation is to build trust across the entire value chain. So the use of regulatory technology would further enhance this trust relationship. The second one there is digitizing and standardization of documentation. Boku talked about this earlier on in her presentation. The need to have standardization across board, right? Because this makes it a lot more seamless. It makes it a lot more easier, and it makes the process a lot more efficient. So standardization and digitization cannot be overemphasized, especially in Africa. The third one there is cross-border trade efficiency. Of course, with increasingly discussions around digital economy and the need for Africa to galvanize towards a cross-border region with a common bloc, the need to look at how to make the process even more efficient, it becomes very, very relevant. And RegTech has a very fundamental role to play in achieving all of this. The last one there talks about responsible data access and management. Data has become a critical part of business today. And more importantly, making use of data responsibly has also become very key. So with RegTech solutions, it will be a lot easier for organizations, for regulators, and even for the customer to be able to have a level playing field, right, in the use of data, in the initiation of data, in the usage, and even across the entire life cycle of data, how it is deployed. So these are key areas we see. Now, what are the benefits of leveraging technology in solving all of these problems? So we see benefits cutting across the different layers, both for the regulator, both for the institutions, and for the customer, right? For the regulator, it will signal the regulator's position as being innovative, being open to changes, and of course, willing to accept some of these new things. It also provides ability for the regulators to review existing regulations and evaluate if they are fit for purpose. Of course, it will also get the regulator, provide some level of intelligence on development, trends, and emerging risk for the regulator. For the institutions or firms, it will help them, support them, and make them to fully understand what is required of them as far as the regulator is concerned, so that they're able to meet those requirements from the regulator's perspective. It also provides a potential testing of technology in a stable but live environment for subsequent full-scale implementation. It provides an opportunity to get advice from the regulator, because basically, most times, the startups don't always have that opportunity to interact with the regulator. But with having a framework that brings both together, helps the startups to really understand what the regulators are asking for, and it helps for better functioning. Of course, for the customer, it provides an appropriate consumer protection safeguard and mitigation of risk to the consumers due to close monitoring and graduated rollout. It can also support greater competition and inclusion due to better targeted and designated products.
Thanks, Cyril. I know that if we...
I'm almost done.
Okay.
I'm almost done. Yeah, this is just one but last. Okay. So just to say that in Nigeria, basically the regulators are cut across 4 or 5 different sections: the CBN, the NCC, the SEC, NIDA, and all, and they regulate different factors, different areas of that value chain. The key initiatives that we see from the regulator in Nigeria specifically are these highlighted. We can talk more about some of these initiatives. They are very key initiatives that help Nigeria to be at the maturity level that it is today. The challenges, I've mentioned some of this earlier on. The future we see for RegTech Africa is a future where there will be a whole lot of collaboration among the different stakeholders, ranging from the regulators, the fintechs, the financial institutions, and the service providers. Thank you very much. Yeah, my details are all there. Thank you so much. Yeah.
Thank you, Cyril. I mean, RegTech, it's an area that's there's a lot to talk about, no doubt about that. So thank you very much. I'd like to welcome Moses Onitilo. Moses from Jambro in UK. Will be making a presentation on financial inclusion. So Moses, please go ahead, introduce yourself, what you do, and then you can go ahead with your presentation. Thank you.
Sure. Hi. I hope everybody can hear me. Sorry for being late. Having some connection issues, but I'm here now. So yeah, I have okay. I have a few slides to present. I'm just going to use my slide to tell a story. I'm Moses Onitilo. I'm one of the co-founders of Jamboro.com, a financial inclusion platform across Africa. We are a fintech company that provides white label solution, software as a service, to access financial services for the informal, unbanked, and underbanked sectors across Africa to provide, to promote economic and financial inclusion, which is a loosely word that I want to talk about beyond inclusion today, which we use financial inclusion a lot in a lot of buzzword the last 2 years or so, who is really doing financial inclusion. So my topic is beyond inclusion. So let me share my slide with you. Can everybody see it?
Yes.
Yes.
Yeah, I'm trying to do a slide share from here, but I can't find. Hold on. Try to move things out of the way. But anyways, so my topic today is beyond financial and economic inclusion in Africa. So
sorry, Moses, can you put it on slideshow?
Sure.
You can give me the access and I will put it.
Okay, yeah. It's not allowing me to do it. It's blocking off something there.
Moses, maybe if you move just 4 steps right to the notes, you will see the slide presentation mode.
Okay, I can do it for that. Okay, can you see it now in the slideshow format?
Yes.
Okay, so my topic today, as I said, is beyond financial and economic inclusion in Africa, and how do you leverage technology as an enabler to financial and economic inclusion? So we've done extensive studies before we actually started Jamboro. We started in 2018, we're a startup. We are currently in 7 countries. To get into those 7 African markets, we spent 2 years between 2015 to 2017 traveling 20 African countries to gather data, actually go and talk to a lot of regulatory bodies and also savings and cooperative groups, which in East Africa, we call them SACCOs. In some of the East African countries, they call them Vikoba in Tanzania. When you come across to West Africa, we call them Susu in In the Francophone countries, in Nigeria, we normally call them Ajo, Isusu, wherever. So our demographic is that for Jamboree. But I'm not really going to talk about Jamboree here. If you want to know about Jamboree, you can go to our website and look at what Jamboree actually does, which I said is a financial inclusion platform, like a conduit to bring together a lot of people in an ecosystem. So what I'm focused on is beyond financial inclusion for the village. So to get to that, you have to be able to gather data. Data is the key word here, KYC data of the village. So what I mean by the village is when you go to the grassroots or the underserved, coming part of our ecosystem in Africa, which accounts for 400 million of unbanked adult population. So if you look at the green is where most fintech platforms are focused on, which is people who have jobs, SMEs that have companies and all of that. But there is this 400 million on undocumented, unbanked out of Africa, which is documented by UN, IFC, World Bank, and name all the organizations out there. So that's our focus. So when you talk about financial inclusion, we're not just talking about giving loans to some people via a B2C platform. Everybody's doing that. We're talking about how do you give create a credit footprint for a woman in the market who is selling something and is part of the economy but doesn't have a bank account, whether you go into Kenya, Nigeria, Ghana, Sierra Leone, they don't have a bank account, but there's a lot of transaction taking place in this red zone, which is the underserved part of Africa that nobody wants to pay attention to because it's not sexy. The financial institutions don't want to go there and gather their data. They want to rather deal with people who are payroll or people who are businesses, but that demographic does a lot of transactions that no African government or no institution has been able to calculate the transaction that goes on with the unbanked population. So our goal is to focus on that 400 million population and ensure they are banked, ensure that they will have a credit footprint by just gathering their basic KYC data and also using our own credit scoring algorithm to create a credit footprint for them as you gather their data as well. Now they will now have a credit footprint to now be able to have access to financial services product. So think of it like this. You have a shopping mall where it's a luxury shopping mall. The circles, the savings groups, and people that reside in that ecosystem are the retailers for this luxury retail. We call financial services products luxury retail items, which is more or less, people are looking for healthcare insurance. The woman in the market does not have healthcare insurance, doesn't have normal life pension insurance for herself or for her family. At the end of the day, she wants to be able to make money to send her kids to school, which brings up the likes of us. Our parents were actually in this under the red zone of Africa in the past. What happens? They were able to join savings groups, whether they travel abroad or wherever they are. They were able to put money together in a job and lend each other money in that ecosystem because the financial institutions are not giving them any loans or any financial services product to service them to be able to carry out their transaction, to be able to carry out their day-to-day lives. So that's why we focus on that. And that's why I'm talking about beyond financial inclusion. So beyond financial inclusion, these are the bullet points I want to discuss. So according to World Bank data, 400 million of the adult African population are unbanked. They don't have a bank account. M-Pesa in East Africa allows you to have a wallet for pay goods and services. That's still not a bank account. So to be able to bank that 400 million, we've looked at how do you do that? So you can do that in various ways, and you can use technology as an enabler, whether it's AI, whether it's blockchain, whether it's any other solutions out there that you have, all the fintech companies. We need to start looking at the real problem here. And the problem is data. How do you digitize the KYC data of the village using the savings groups model, capturing, having a relationship with those savings groups and be able to onboard the data and of their members onto a platform, which is what we do as well. So as I said, the savings groups across Africa are called SACCOs, Ajo, Isusu, or Susu, right? Then once you've digitized all of this, and since Africa has a huge mobile phone penetration, whether you're using Android, iOS, and also feature phones to use USSD technology as well. So digitizing the existing regulated and licensed savings group process and practices is what we have done. We've gone to them, we say, okay, let's look at your current processes and practices of how you onboard your members, of how they save every month. They save for 3 months, and then you can borrow 3 times the amount that you've saved in that group. But they are not being serviced enough, because if 15 of us are in the group and 15 people at the end of the month wants loan, you won't be able to service that. And most of us don't have health insurance, we don't have pensions plans, we don't have affordable housing. So once you are able to digitize the KYC and you are able to onboard them into a system, you can now start to create a credit footprint by building a credit system for them. We've developed our own credit scoring algorithm, so we are now able to build credit footprint for these people. What happens after that? These people, this demographic will now be able to go to a financial institution and say, look at my credit score. I've been able to save this much in my group. This is what our group has and everything. And look at our wallets and everything. We need this amount of loan. We need healthcare and nano healthcare insurance. We need life savings for our group. Also, they will be able to talk to financial institutions that can give them funding for mortgages for affordable housing as well, which we've been able to create for them. So the rest of these bullet points, I will use a particular case study of 500 women that started in Kenya saving $1 a day. So, and as you know, women in East Africa, they don't give them access to be able to own land in some of those countries as well. So they started with saving $1 a day. And as of right now, forward to 2021, they now have 2,000 members, because they've been able to onboard. We've been able to onboard our KYC. They've been able to create all the processes and practices that they use for their savings group on our digital platform. And now all the financial services companies now have access to their credit history, to their credit footprint, to all their financial information, and say, hey, they just bought 43 acres of land, these same women, by just saving $1 a day, every day, since 2015 up to now. They bought 43 acres of land. 20 acres of land are going to be used for farming, and those crops will be used. The residue of that will now be used to buy more land. They're using the 23 acres of land to build affordable housing, which we've been able to source those financial services products and affordable housing products for them to be able to build 40 units so far for those women. So this empowers women as well. So if you look at that demographic is 80% women as well. So women are being discriminated against in African grassroots ecosystem. So when we're talking fintech, when we're talking financial services or financial institutions, the majority of people who are excluded in this demographic are actually women who run the entire market ecosystem of Africa. And if they shut down a week, just 1 week, the entire market system in Africa shuts down, those women shut down, the entire ecosystem in the grain that I showed in the pyramid before will collapse. I don't care how much foreign investment goes into any ecosystem. If those women across Africa shut down that 65% in the bottom half for 1 week, the entire African ecosystem will collapse. So using big data repository and their credit history, we're able to mine the data for them. We're able to share the credit history and credit scoring with financial service providers, which I call the retailers, luxury boutique stores. And then what does this mean? Now be able to transition this demographic out of poverty, you know? So you now have a credit footprint, you now have financial institutions who are giving you loans, who are giving you healthcare, so now you can now go to hospitals that you can't afford to go to before, you know, and the value proposition for everybody else is, you know, a financial institution, you have more customers to open accounts that will now be open to open account. You don't now need to go to the grassroots and start using paper to open an account for these women, and also these women or these people in the demographic on the underserved are afraid to go to the banks because they're going to put them through hell to open an account. So what is the goal here? Banking the 400 million who are unbanked in Africa. If we can get to that, yeah, it alleviates a lot of poverty, and it now elevates the economy of Africa across board. Every player, whether it's red tech, whether it's insure tech, whether it's financial services, now be able to offer the services that this demographic deserve. That's what I term beyond financial inclusion. It's not just financial inclusion. It's a lot of things happening. And the key to this is empowering women, because they make 80% of that demographic. When we empower our women, I'll conclude with this. Since 80% of the demographic are women, we need to focus on better education for our girls, which lead to better health and economic outcomes. Inclusion of women in the formal economy will lead to better jobs, healthcare, credit footprint, better entrepreneurship, and economic empowerment for our women, which narrows the gender gap in this ecosystem. We do know women are half of the storm. So I conclude with that, saying when we go beyond just financial inclusion, we provide a better economic empowerment for that demographic. Thank you.
Thank you, Moses. I mean, very, very revealing, and it's amazing what Jambora is doing. So, I mean, that's, and already I can see a question, how would digital financial inclusion contribute to Africa's development? And I can see what Berko's, in terms of legal entity identifier, RegTech, fitting into supporting financial inclusion. There's a weave. I mean, there's an interaction in that. So I mean, so back in Nigeria, where what you call the bank in Nigeria, which is similar to the LEI. I mean, shouldn't you be talking to our own regulators and see how there can be an interaction with that? You know, especially now that Africa is talking about the free trade, cross-border payment is a major issue. So, I mean, how do you think the LEI will be of value in terms of the African Free Trade Agreement?
Yeah, thank you so much, Babatunde. Indeed, I mean, actually in Africa now we have 3 accredited LOUs. So we have CSCS Nigeria, who is issuing LEIs to Nigerian entities. We have Straight in South Africa, which is also issuing LEIs to South African entities. And we have Tunisia Clearing in North Africa, who became recently accredited, and they're providing LEI services to Tunisian entities. So we have some presence in Africa, but as you said, I think we can achieve more together. As you mentioned, all of us are stronger than only one of us. So definitely, I mean, we need more cooperation and coordination. As you mentioned also, for instance, in Nigeria recently, an open banking framework has been published, for instance. So we also see that there's a great potential for the LEI there, because open banking relies on secure data sharing, right? And if you cannot share data secure on a transparent manner, then you cannot really achieve what you want to achieve. So the LEI definitely can be a foundational step in achieving upcoming project and existing projects in Africa. As Cyril mentioned, digitization of trade financing documents will be also a great outcome of the African Free Trade Agreement. So that's why we think that there is also, particularly with COVID-19, at the global level, there are efforts to digitize trade documents, which are quite manual and very paper-based, basically. And we saw that how these paper-based documents failed during COVID-19 when the, let's say, letter of finance document would not be arrived on time from, let's say, Singapore to Nigeria. So that's why we think that the LEI, with its digital and machine-readable features, can really become a cornerstone of all these digitization efforts, not only in Africa, but on a global level. And I think in the past, we all learned from our past experiences that the regional or local identifiers or standards do not work well on the global level. So we need a global standard for identification, and we need to adopt global standards for being able to speak the same language at the global level.
Thank you, Boke. There's a question that says, how can industry associations as regulatory bodies bridge the gap between regulation and innovation? I'm sure that question is meant for me. So, in my presentation, I'd said in Nigeria, what we have done, that's is to set up what you call a regulator forum, where we have the regulators and the innovators coming to sit together to discuss. From Cyril's presentation, said there are progressive regulators and there are restrictive regulators. In the progressive regulatory environment, you see that regulators are actually the ones driving the fintech ecosystem, like you see in Singapore, in UK, in Lithuania. But in other climes, it's not that the regulators are a bit restrictive. And the only way to, and because technology is always ahead of regulation, the only way to do that is to bring everybody to the table where you can share ideas, you can see where the regulators are coming from, they can see where the innovators are coming, and we can meet somewhere that makes sure that, products are delivered to the market grows without regulation being impaired. So I'm sure that there's always a bridge. That's a bridge to be able to, for us, that's what we have done we are doing in Nigeria. So let me go back to Moses. Financial inclusion. For me, I've always felt that just trying to get people to open accounts is not just enough. You should be selling benefits to people. So, so if I go to a farmer, what are the challenges of a farmer? He's probably concerned about snake bites, he's probably concerned about scorpion bites, he's probably concerned about injuries on the farm, he's probably concerned about health issues. So if I'm selling him a health insurance, it's easier for me to get him to be financially inclusive rather than say open an account. I don't know what your experience has been in terms of the environments you've been to. Maybe you want to share that with us if that's your own experience, because we've had these issues all along. Sure. With regulators. In Nigeria, we've not been able to really move. The target was 80%, but I think we're like 50-something%. So, what could make that difference?
So in our experience, when we do our research in the 20 countries I spoke to you about, we were actually in direct contact with the farmers, with the women in the market. We're not talking to just regulatory bodies. So we were actually in the grassroots itself, in the villages, sleeping in the villages, trying to understand what their problem is and how technology can be used to solve their problem. So if you look at in Nigeria, in Ogun State, there is a movement called the Alajakwas. The Alajakwas are thrift farmers, cassava farmers, yam farmers, and all of that. We've been able to sit with them. They transport most of their produce from Ogun State to Lagos. But along the lines of the transportation, they encounter the safety corps, corruption, who are taking money from them. By the time they get to Lagos, some of those are perishable goods because they've been delayed, or the prices of what they're going to make in terms of profit will have diminished because all these people have taken bribes before they got there. So we've been able to help them with the bringing in the technology that records all the bribes that was taken and reported back, whether it's USSD via the German government that provides that technology, right? So, and a lot of them, you do cash transactions. So when they meet in the cooperative societies, they have to use cash. Okay, I'll give you 1,000 naira in our group. That's how much we save every week. But we don't have healthcare insurance. We don't have, crop insurance. So we've been able to plug in nano insurance to protect their crops, and also connect them with microfinance insurance banks who give them reasonable loans if they can't satisfy their loan books as well. So that the interest rate is very low. You don't want to do predatory lending to people who are already poor. So that enables financial, and before they take a loan in the groups, we've also been able to provide financial literacy product on personal investment, on seeds, and all of that. So all of that is part of what we call financial inclusion, not just opening a bank account for them. So all of that ties into everything. So with that group, with the groups in Kenya, in Tanzania, in Zimbabwe, in Namibia, in Sierra Leone, we've been able to do that on our platform, connect them to that. So then we have other financial services, products like more lead financial literacy from a client who said, I just want to provide financial literacy to this demographic in forms of a video. I don't want any money from anybody, and I just want to take credit for doing that. So we've partnered with UN, IFAD, IFC, and a few other NGOs in the US to be able to bring in various help and assistance. We're working with IFAD on the farmers and agriculture because we have a client who's creating farming communities in this ecosystem using our platform as well. So it goes, that's why I said beyond financial inclusion. Right. So it really goes beyond just financial inclusion. Hope that answers the question.
Yeah. Thanks, Moses. So, Cyril, if I come to you, looking at trying to align identity, going beyond financial inclusion, and the regulators wanting to achieve financial inclusion. You're into RegTech. I'm sure you speak to these regulators. What will be your advice to them?
Well, I would say a lot of the West African countries.
This was Cyril.
Oh, sorry, RegTech. Sorry, my apologies. Okay, sorry.
Okay, if I get you well, you're asking how identity issues align with the regulators' requirements. Am I correct?
So we're talking about, this all boils down to financial inclusion.
Okay.
One of the challenges with financial inclusion has been, issues of data, identity management, and then what's it called? Regulators setting targets for themselves. In view of what we've had, what Jambro is doing and the experiences they've had with what Boko is doing, and with your own experienced regulators, what will you be saying to regulators now in terms of achieving financial inclusion?
Okay, basically, identity in Africa, particularly, it's a big problem. It's a big. When I say identity now, I'm talking about national identity, right? It's a big problem because you take example of Nigeria. You take Nigeria for example, right? We have bunch of identities, stacked all over the place in silos, right? The driver's license, the regulator for driving for the driver's license has got all identification, in its own database. We have for the telcos, we have for the passport office, and we have for the banking system. So we have identities scattered all over the place. But the problem really has been that of harmonizing all of these identities all over the place such that they are able to be trusted, and you can actually rely on them for the purpose of financial transaction and by extension achieving financial inclusion. So I think from the regulatory point, engaging the regulators, one key thing would be, how to get all of these different silos, to be properly harmonized. I know for about 2-3 years now, the what do you call it? The NIMC, the regulatory in charge of identity management in Nigeria, has been trying to, work with the CBN in terms of harmonizing the BVN, right? Why the BVN has got over 40 million captured identities. That's for the banking sector. NIMC has got less than that. That's the National Identity Repository, which is supposed to be the fundamental one. The BVN is supposed to be a functional identity repository, while the NIMC's database is supposed to be the foundational one. So you find out that, having a need to harmonize all of these silos would, to a large extent, address this. But what most organizations are also doing, just like what Moses explained, in their own little way, because leveraging a massive infrastructure to achieve a central ID repository is actually huge and cost intensive as well. But in little ways of individual providers, they can leverage technology, right, to leverage technology to make sense out of the data, out of the daily lifestyle data available, to be able to take some informed decision for credit purposes and for all of those things at that level. But again, you also have to look at this based on from the risk perspective. What is the extent of the risk you're looking at in terms of the amount of money involved in the transaction vis-a-vis the decision you're taking? So okay. I think there has to just be that balance. We have to strike that balance, really.
All right, thanks. So, okay, Moses, short one, but we're running out of time.
It's going to be a short one. I can also say West Africa and Nigeria need to take a leave out of East Africa. So knowledge transfer in the East African segment, the savings groups and cooperatives and credit union in East African region, especially when you're talking about Zambia, Uganda, Kenya, especially Tanzania, are very highly regulated. So when you look at Kenya, for example, they have the SACCOs, SASRA, which is the regulatory body, which I have met, and we have partnered with them to look at what their regulation. They regulated all the SACCOs. They have data. All those savings groups have data of everybody, including their IDs and everything. All national IDs, all regulated. So they're able to influence, financial inclusion in that way, because most of those bodies are regulated. When you come across to Nigeria, on the other side, a lot of our cooperative societies are not regulated. There's no regulatory body other than the CBN that is regulating financial transactions and everything. So if we can put together some regulatory bodies for all our savings groups, then they have a mandate. Each of the savings groups will have data, verifiable ID. Even when you go to the villages, they will have some form of ID that's already loaded to their core. So it becomes easier. The issue of having multiple database will become easy. If you have a regulatory body at that level, the issue of data becomes easy. It's just data sources. What Nigeria is doing doesn't make any sense, and it's not regulated. When you go to East Africa, a lot of countries from West come to go and train with the regulatory bodies in East Africa. That would be a first way to start.
Okay, that's fine. So, Buck, there's a question here. Someone wants to know what are the benefits of having an LEI for my organization?
Yes, I think it would be nice to answer this live. Indeed, it depends on the organization that you're representing. If you're a financial organization, let's say, you will be adding on more client service, so customer satisfaction. You can use it. You can use the LEI for faster renewal of KYC procedures during refresh cycle. So you can avoid potential contractual fees for delayed onboarding or AML fees because you will be knowing precisely whom you are doing business with. At very, how to say, from a backend perspective, you will be enhancing your internal data management processes. So you will be having greater consistency with standardized entity data in your files, and it will be returning reduced onboarding time for your clients. And of course, when you use the digital identifier, you can also accelerate digital transformation. You can use the LEI in digital certificates. You can ask the client to submit its application in digital certificates, or you can leverage verifiable credentials, as Moses mentioned before. So, but if you're a corporate or if you're a SME, let's say a small and medium enterprise, then your use case would be different than a financial institution would have. For instance, if you're a corporate, we know from corporate treasurers that they do not have a master data, and it's very difficult for them to precisely identify their subsidiaries all over the world. So once you have a precise data, you can have better plan your resources for internal payments from a treasurer perspective. And from an SME perspective, you can access the cross-border payments, credit facilities, and easier and without identity restrictions, because as I mentioned, particularly in Africa, also in some other parts of the world, trade financing gap is increasing, and this is due to the fact that KYC checks and client identification requirements are getting harder and much heavier for financial institutions. They do not want to onboard new clients, and you can overcome this challenge by adapting the LEI.
Thank you. I think we'll probably have to round up here. I know there's so much to talk about. So thanks, Buck. Thanks, Cyril. Thanks, Moses. The financial system is as stable as the regulations that govern it. So regulation is important. And using technology to drive regulation is critical as we're moving into a digital world. So, so there's no doubt that RegTech is going to play a major role in terms of how economies grow. And technology, like I say, is like a moving train. You have to be on it to enjoy the ride. If you're outside of it, you'll be left behind. And I think it's time for Africa to be on the train. And let's see things change dramatically. Thank you very much, everybody. And back to you, Angelova.
Thank you, and I'm agree with you. There is so much things to talk about, but the time is it's not so many. So we didn't have time for this panel anymore. We have a few questions that you can answer with, but I will share the questions in the FinTech group in LinkedIn and share the link with you so you can answer the questions that are for you. And we're going to have a 15 minutes break, and then we're going to go back with the second panel, which is hybrid digital customer experience. And stay for the next panel. Thank you all. You've been great panelists. Thank you so much for being here.
Thank you for having us. Thank you, Babatunde,
you.
for the moderation.
Bye.
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 Bye. Hello, everyone. How are you?
Hello,
we are ready
morning.
to start with our second panel, which is hybrid digital experience. We're going to talk about digital engagement post-pandemic. First to start is going to be Mr. Christian Cajunieri. He's going to talk about open banking. And Mr. Christian Cajunieri, please, can you say a few words about you and to introduce yourself to the other panelists? And
Hello.
hello.
Can you hear me?
Yes, we hear you great.
Okay. Hi, Stanislava. Thank you for the opportunity. My name is Christian Cajunieri. I'm passionate about digital payment, fintech, B2B, B2C in Africa. I've been in the space for more than 10 years in different roles, but the passion has been more not career, but more as an entrepreneur. And this is a great opportunity to share. I'm always happy to share and talk about fintech in general. And I have been an advocate of open banking, though it's still considered as a threat to some banking institution. But I advocate about it of more having a customer experience and pricing experience. So I don't know if you allow me to continue to do the presentation or it was just an introduction.
Yes, you can start with your presentation. Do you want me to share the screen and give you the access, or are you going to share it by yourself?
No, you can share. You can share.
Okay, let's a few seconds. Here, I give you the controls. I'll now know you're on.
Okay, thank you. Thank you very much, Angelova. So open banking, that's what I'm going to talk about next. Next slide. Okay. I'm the head of payment at Equity Bank, one of the largest banks that we have currently in Central Africa and East Africa in terms of customer base and even market size and capital assets. Open banking is a concept in financial services as part of a technology that uses the open API concepts that enables third-party developers around the world to get greater financial experience for the last end user or account holder and provide a better access of open data to private data. Next. It's a very revolutionary concept in the banking sector. It provides to users a various platform of banking services. And as a result, the whole banking experience becomes transparent. And furthermore, it gives to other third-party enabler and service providers, whoever is in the sector play of financial services, it being insurance, wealth management, investment, and any other related domain. Soon, we are going into cryptocurrency. I know some organizations in some countries already advanced, and digital banking that has been there for decades. Next. So these are the key players in open banking. You have the regulator, you have the risk and fraud mitigator, you have cybersecurity, which is a space that we cannot ignore. We have the tax authority, we have the technology part, we have data management and analytics, we have the deal and structure, those on the commercial part. You also have the customer centricity when it comes to customer experience, and building a strategy and a business model. Next. So what is open banking? You have 4 to 5 aspects. You need to develop a reusable programming component. API should perform basic banking functions like customer account validation, funds transfer, balance inquiry. And third, you need to have a bank to push API over the internet with security features. I'll talk more about the security features exposure that you get when you go into open banking, and that's one of the biggest challenge that the open banking concept has today. 4, 4 is partner and client application websites to integrate with the bank, and 5 is the partner application websites will now have to perform the bank function. Next. This is the whole ecosystem 360, the kind of services that you can have. You can have an account internet service provider, a payment service provider, banking experience, bank apps and experiences. That means channels that you use to do your payments. You have the customer data, you have digital lending solutions, you have fintech partners, and you have core banking accounts. Next. The 3 key principles that open banking needs to rely on. The first one is real-time sharing of data, including statements and transactional data. Currently, most banks charge between 500 cents to $1 per page when you're asking for a statement, but this is a service that should be done free of charge when you have an open banking concept. The second one is real-time initiation of payment that allows other organizations to initiate payment. Now, in Rwanda, for example, we have a project called RNDPS, the Rwanda National Digital Payment System Integration, that is aiming at lowering fees of transaction between telcos and banking and interbanking transfer. Because currently, because everyone is owning their account banking system, they put on the in-house clearing charges, back office charges, and operation charges, and hence being heavy on the end user. But when you have done a switch and you integrate all under one platform, the open banking becomes more easier and minimizes the costs, and financial inclusion is more faster. The third point is informational product and services comparison. The open banking now brings to the end user a variety of services and products, and it creates more the experience or the competitiveness no longer on just pricing, but the customer experience. I have been telling internally to my organization and wherever I've been before the bank industry, the area we're entering in, it's no longer about pricing, it's more of convenience. People are ready to pay for whichever works, and as long as it is transparent, what am I paying and why am I paying what I'm paying, what services am I paying. In the use case, you will get either a top-notch organization like Amazon, Tesla, and so on, where they make money out of selling convenience and state-of-the-art technology. You can also go when you're working in a mass market area like India, China, countries like Nigeria, South Africa, DRC, and so on, or Ethiopia, which is opening to the world soon. The concept of open banking will work more when you apply the concept of freemium model, which is the concept of WhatsApp, Facebook, Alibaba, and so many other solutions, where they ride on the mass and they make more small margin on very little instance, or they give something for free to get in return something else. An example of a freemium model is Cheaper Cash. Is a new concept funded by Amazon owner, Jeff Bezos. Cheaper Cash is going to do remittance free of charge, but their niche or their source of income is more on FX. If you get volume on money remittance, especially focusing on refugee, he'll be making money on the FX by trading. So the freemium is a portmanteau as a word. It's free and premium. Is a pricing strategy by which a basic product and services is provided free of charge, but money as a premium is charged for additional features, services, or virtuals, or even physical goods that expand the functionality of the free version. Just to I allow myself to delay on this slide, but I'm closing by mentioning that the open banking opportunities to work with new organizations and provide consumer and innovative solution, but also creates a new space of new compliance, key metrics, and governance question to ensure that organizations can protect consumers' privacy and support consumers to get the value out of their data. So the biggest challenge the compliance and the regulator will have to answer is to ensure when data are shared with the party that you do not expose to fraudsters your customer or every bank's customer data. Next. So this is the open banking standard. You have the data standard, competency, and security standard. This is, I had to mention it on the previous slide and to introduce why it's critical. The data sharing space, we really need to have a governance to operationalize the banking standard. I think this is why the adoption of open banking is still a challenge by most regulators in most markets. The rules by which data are described and recorded. Next. Open banking as a dimension, you have the customer relevance, you have the open API, and you have the digital identity. This is more of a repetition of what I mentioned, but you need to leverage on KYC onboarding capabilities. You need to have a consent management of every customer that has to be onboarded. You need to have new revenue streams enabled to the feature. You need to have a compliance and opportunity, link services to end infrastructure layer. Next. Example and use cases. We are towards the end of my presentation. You have cash management, which is the biggest challenge. You have AI and IoT. You have virtual banks. You have digital checks. You have cash access and personal advisors. These concepts have been mostly neglected globally, but I think COVID has speed up the whole process and created a demand as an essential service to move to digital banking services. Next. This is how the whole common banking functions framework looks like. With the platform model, you have accounts, you have payments, that's my area of specialization. You have data, you have KYC, which stands for know your customer. You have core banking, you have the banking license, you have the customer support, and you have the branding area or customer experience. Now, where you do an API integration, what you need to focus on, what opportunities available is securities, wealth management, lending / digital lending, crowdfunding, like GoFundMe and so many others. You have digital payments. Remittance has seen an extreme growth. Currently, the bank has grown more than 300% year on year on remittances, and I expect it to continue to grow. You have cryptocurrencies, you have insurance, an area also to focus on. Most banks have entered that space, but they're still doing traditionally. What we need to look at is how to digitalize all mandatory insurance for motor and all that. You have pension. The government of Rwanda has digitalized the pension and even separate for those who don't have regular employment. but do casual work, how to do pension, and it's on digital, it's on USSD, even onboarded through API to the mobile banking app. We have mortgage, we have quick loans below $500 for the micro SME or the bottom of the pyramid. Those are small products that when you work in an area like Africa, and that's where you have more than 80 or 75% of the population, and it creates financial inclusion. So you also have investment and trading, which is part of the middle and top of the pyramid of our economy. Sometimes the digital area of it is not really focused, because you realize the age group of people in that area are a bit older, and so the urge of digitizing is not there. But to make the whole banking experience faster and quicker, that's where open banking is a solution provider. Lastly, you again have to make sure you have security and control. Next. So these are benefits. You manage escalation of costs, and by launching a new digital service. Second, you meet dramatically evolving consumers' demands and offer with more choice to the customer. It offers innovative products and services, thereby helping banks to compete with fintechs. And this is why I like saying that actually this is an enabler to banks rather than considering it a threat in the benefits of fintech. Another point is it develops strategies to monetize customer data to generate new revenue streams. And I want to explain this in which way. Where the bank is going, you need to address by AI and IoT solutions, machine learnings, you need to be able to create a social impact, and the bank become a lifestyle of proposing tailored customer marketing messages on social media to your customer before they even request for them. So basically what I mean, if you have all data of your customer and you know they like purchasing online using a USD card, or let's say a Euro card, whenever you have a discount or a promotion, you can partner either with Visa or MasterCard to get a tailored campaign based on the collected data. Now, how amazing it is when you have it collected by your customer in an open banking platform where you know what your competitor is offering so that you can immediately adapt to the market. So it gives you visibility. So what I'm trying to say here, the open banking third-party solution provider will not only be selling the service transaction, but also selling data, because they'll be generating a lot of data in real time. The other point is also meet the regulatory requirements to provide higher transparency on the data. Next. Allow me to skip this one. I think I mentioned a bit about it on the merchant. Even this one, it's more of a structure and more technical. Next, Andrew. Oh, yeah. So advantages, go back a bit, thank you. So we have advantages that you have. Okay, thank you. I want to talk about advantages and disadvantages of open banking. So a customer reaps the open banking of choice. This is a benefit to the customer. Second, more customized and relevant products offering, benefit to the customer. Easy way for the bank or for banks to extend their services. It's a benefit to fintech. If you do a revenue share model with fintech as a bank, meet the customer requirements. It's also a leveraging opportunity for fintech. Now, disadvantages is that it's relatively new. So there's a lot of opposition and fear. Everyone wants to safeguard their customer base and actually continue to grow it. And because they have a lot of gaps in-house, exposing them out there might create a losing opportunity to your competitors. Second point is the security concern, data privacy especially. That's where the regulator will spend more time. And the other one is limiting opportunities. So if so-and-so fintech is not willing to onboard and still want, maybe they're a major player in that area, they will want to keep separate and not come and integrate their API with the open banking third-party platform. Next. Next, I'll have to skip one. I think I mentioned it. This is the closed banking and open banking. I will request Angelova to share this to whoever is interested. You can always reach out to her. But it talks about price comparison website. Next. Yeah. So I wanted to mention the 15 open banking innovators that I managed to get online. You have Clio, Calgera, MoneyHub, Toucan, Tally, Moneybox, Plum, Credit Spring, Spotify, Graft, Whetstone, and so on. The list is long. And I've tried to put them in categories. You have personal finance management, you have savings, you have debit and credit and alternatives. Next. So wage stream, what they do in a nutshell, I picked few of them, and you can always check the link below. Wage stream is designed to help shake up the way we get paid. It's more of a payment solution. You can check more details on the link. It is more detailed. You have Moneybox. Go back a bit, Angelova, sorry. You have Moneybox that enables you to start saving with your spare change. That's an amazing concept. I encourage everyone to read it and actually replicate the same concept in your country. Credit Spring charges a monthly fee to access the 2 pre-approved loans a year, giving people with low levels of savings as an alternative way to borrow for unexpected costs. This is an amazing concept. I think credit analysts will be happy if you have an automated way to do this in every bank. Canopy is a rent reporting platform that allows you to make sure the money you spend on rent counts on your credit report. Isn't that amazing? Mojo is an online mortgage broker that is trying to wield the data of open banking to help people borrow to buy a home. I've seen this. I have a Nigerian friend that is trying to implement the same concept in Nigeria, in Lagos. It's called Fast Home Africa. And yeah, so I will end my presentation here. It's always a pleasure. Thank you for Digital Africa to give me this platform. It's always an honor. I don't know if you have time for Q&A. I'll hand it back to Angelova. Thank you.
Thank you, Christian. I want to ask you a question. According to you, what is the biggest challenge for open banking? Because in our previous panel, we're talking about that most of the African people, they're unbanked. So is that the biggest challenge, or there's something more? What's your thoughts on this?
So talking, and I'll answer the question in two areas. The biggest challenge we have today in Africa is actually not open banking, is access to finance. Let's put it there. We still have the biggest population that is unbanked. The biggest challenge, again, we have in Africa is not open banking, especially in the sub-Saharan region. It's micro loans, nano loans, digital loans, because we have limited infrastructure. But when it comes to open banking as a concept that will, for sure, speed up, especially post-COVID area, it's the data privacy, balancing innovation with security, fast-paced technology changes, big techs that wants to swallow everything, the fintechs, diversity that is still limited, the mindset of bankers that is still traditional financial service provider, the terminology itself, it's totally new, and the lost in tech translation. So those are a few challenges I managed to highlight, but it's more of a futurist concept, but it will eventually come later or now. Thank you.
Thank you, thank you. Now we're going to proceed with with our second panelist, Mr. Sultan Al-Hamidi. He's going to speak about new and changing customer behaviors. Hello, Sultan. Can you say a few words about you, and then you can start with your presentation and with your topic.
Hello and hi everyone. This is Sultan Al-Hamidi. I work in the Social Development Bank. This is a semi-government bank that looks after the relationship and the loans. We're talking here about 5 years loans for low-income segment as a personal finance, of course, and then also part of the development plan to work with the SMEs also, where we have loans ranging from $10,000 up to $1 million for the SMEs, for all the segments. I work there as a deputy CEO, manage all the business with the branches. So when we talk here about the hybrid model, taking into consideration the post-pandemic that happened last year. So the bank was looking after the customers with a certain workflow and customer journey that has both partially manual process, because the relationship between the government and the entities, because we're serving the ministry's employees and whatsoever. So we're using, for example, the mailing system. We're using the current platform in the ministries. So what happened now after the pandemic and during the pandemic, mostly with the lockdown, all the government staff, they couldn't really approach their working environment to get certain paperwork and to get the appropriate approvals. So what we did during that event was to cut off most of the manual work, and we managed to do in-house a platform that works, of course, on mobile phones. And in such process, we even managed to have direct connection with some of the government entities. And that reduced the journey from 16 days that sometimes it takes for the staff to get the loan, up to now we have 3 hours, I would say, turnaround time. And this is really a huge development. Now we have around 30% of the loans goes like in 3 hours, and we do have around 50 to 60% going in like maximum of 2 days. So what we noticed also from a change in behavior is, of course, it's a common sense that we see customers reacting and they like such development, but you need some commitment from the entities, from the government entities. They need to check. Now they work closely with the bank. They have this platform. It helps in granting loans and in collecting loans also. And it helps also where we introduced a new product. It's like a additional product on top of the loan. We found out that with the certain studies that the saving products combined with the loan product, it's very strange that the same behavior happens where we have someone who is looking after the loan and also can save money. So what happened is that also we introduced, and also this is, I think, we noticed that because everyone is in a lockdown, they couldn't really spend. So in like 2 months, they have, I would say, good saving, but we noticed even the behavior afterwards. So after the lockdown, people they start going out and the shops are open and even more working hours happen. So we used to introduce a product only for saving. So for everyone who going into the process of getting a loan, we mandated like a 2 minutes video where we show you what is the saving product and how it works and what's the benefit. And we with also partnership with a local bank. It's a large bank here. Where we ask customers, they will get the loan, of course, but before getting the loan, they will open a saving account, sorry. Then they get this product. So every month, let's say that they're getting a loan with around $20,000. Every month they have to save certain amount, and we're promising them you will get 20% of what you are saving, but for a period of 5 years. So every month there will be an installment. We manage your behavior and such that we notice how does it really impact paying, of course, the loan and the saving that you're doing every month, and until the 5th year end. So it's around 60 installment with a 60 saving also increment that happens in the saving account. Now, if you look at I would say such product, and we're serving the low income segment, we said it might be difficult really, because we're talking here about the really low segment, $2,000 salary. This is the monthly income. And what happened, and we noticed that 75,000 of what we are granting. So every year we have around 80,000 customers. So in 2 years we have around 160,000 customers who got the loans. So and during these 2 years, we noticed that 75,000 of those customers, they have accumulated worth of $40 million worth of a saving during these 2 years. And we even dig deep on what is their, I would say, either their monthly income, how many households they have, and the family size, and of course, male, female, from what areas are they in? Because we have in Saudi Arabia 13 areas, of course, including the capital city. We notice the change of behavior after the pandemic, and it continues until now. We see even the growth coming now to 2021, and we have now higher target. So what we're looking now after is it's an idea that came from even one of the customers to have like dedicated app for the saving to help the families. So what we're doing right now is to introducing an application that serves the family. So you have a saving product, and then you have with the saving product, you could have like targets to your family members, your either your children. So they will have like a yearly target. So let's say that they want to get PS5, PlayStation 5. So they know now the price, and we help them accumulate every month. We give them like incentives, and they need to watch like YouTube videos. They need to watch some material to educate them about the saving. This is part of the financial literacy that we're having. part of the bank. And this will be introduced soon, definitely. I don't want to take much more really of the time. This is what we have experienced during the pandemic and post-pandemic.
Thank you, Sultan. I just wanted to ask you something. You said that you have a growth in the customers after the pandemic starts and with the lockdowns, and it's only in the loans, I guess. So did you have some percent approximately how they grow, or something that you see they growing in the next years, or you think it's going to be only just year and the next year 2021 is going to be to everything going back to normal?
Okay. What we noticed as a growth after the lockdown specifically, we have seen like a growth of 15%. But what we noticed end of the year and until this month, we see approximately 2 to 3% growth in the portfolio. I mean, whether in the saving or number of accounts.
Thank you so much. So we're going to start now with Mr. Pim Massing. Pim, it's nice to having you here, and you can share a few thoughts about you and your topic. Your topic is fintech and digitization for last mile distribution. It's something that you experience, and we're going to talk from this. So
yeah, thanks, Stanislava. Can you hear me first? Let's test that.
Yes, I hear you perfect.
Good, excellent. Yes, thanks, Stanislava. Thanks for having me. Exactly, that's what my talk is about. I've got some slides, so let me see if I can share my screen. Do you see my screen right now?
Yes.
Excellent. Yeah, so maybe a little background about myself. So personally, I have a background as a software engineer and as a software consultant. So that may be a little bit different than most people here in this conference. I think a lot of people have more of a financial or an entrepreneurial background. And I come at it actually from a code monkey, someone that likes to code, although I've been working as a consultant for 3.5 years. I wanted to talk a little bit about something more practical. The company that I've been working with, we've deployed a fintech solution and we've learned some lessons while doing it. And I hope that some of these lessons will help you as well. Yes, Enable Digital, the company that I'm working for, is a software consultancy company founded about 4 years ago. And we are focused on emerging markets, mostly sub-Saharan Africa. The problem that we're trying to solve and that we see is that there are many companies in emerging markets that are underperforming or failing to reach scale because of their IT. It's a problem that you see everywhere in the world, but it's more prevalent in emerging markets. Our current service offering is technology assessment and due diligence for investors. We also do actual implementation, mostly data related. But that's not what I want to talk about today, because we've been around for 4 years. I've been working at Enable for 3.5, and a large while of that, what we did is we built a fintech application, or better put, we created a microfinance software application network and deployed it for about 8 companies. 4 years ago, what we realized is, and it's a bit related to the open banking presentation that we just had earlier. Rather than having a single monolithic software solution or a single vendor that's going to solve all your IT needs, companies would be selecting several third-party best-in-class software applications and integrate them. So you would pick a solution for your inventory management, for your HR, for your accounting, for your payments transaction, for your sales. You would pick different applications, you would integrate them and automate things that way. So, we had this vision and we set about creating this network of applications and integrating them. We also created one of our own applications. Here you can see a screenshot of one that we developed. It's a way to manage loans, most critically microloans. And yeah, again, so who do we work with? Mostly companies in sub-Saharan Africa, growth stage SMEs, about 1 to 2 million in revenue. We also work a lot with investors. The software that I just talked about, or software network, I should say, we deployed it for last mile distributors. So mostly the energy access space. I hope most of our listeners are a bit familiar with this, but I'm not too sure. It depends a bit on where you're from. So our customers were companies that sold essential products, usually water pumps or solar home systems on a loan basis or pay-as-you-go basis. So you would have a consumer pay $100 over installments of $10 a month, or maybe they would purchase a water pump to increase their agricultural output, and they would have to pay $1,000 and then pay $100 per month. So these last mile distributors, they are for profit, very important. And they're a bit like a microfinance institution because they have a huge loan book, and they don't tend to have a few hundred customers. They have thousands, tens of thousands, hundreds of thousands, and the more the better. And this is also why IT is so essential to their operations, because you can run a few hundred on paper or on spreadsheets, but no way you can do a few thousand or even more. Also, these companies, these distributors, yes, they are MFI-like, and they do loans. Are they really fintech? You can debate. I would argue not. At the very least, they're not building a software as a service IT product, right? So it's not really open banking, but open banking is very important to them. They make use of it. The learnings. I will try to keep it short. First major piece is you can leapfrog the technology of a company, but you can't, leapfrog the people that use it. Very simply put, we wrote a manual and it had lots of screenshots. It wasn't very dense. And even though our customers had worked with it for years, nobody ever read it. Like every time we would get questions that we would consider very basic, we would say, oh, well, you can look it up in the manual, this and this page. And we would get the same question the next week and the next week and the next week. And it wasn't that our customers were dumb or stupid. No, I mean, they're intelligent people. I don't want to say that. It's just, that's what happened. And I mean, I think we're used to software being self-explanatory and super easy to use. But if you go back to the solution that we offered, it was very advanced. And the reality is these advanced features were rarely, if ever, leveraged. The cool thing about this application network is that, if there would be a new open banking software available, or if there would be a new blockchain, cryptocurrency, quantum computing, AI software, third party on the market, is that, instead of being vendor locked, you could just go and integrate with it and expand your business. But nobody really did. You can, releasing such an advanced software solution to these companies, it just didn't really work. So, if you want to deploy something advanced, you need to make sure that the people and processes are in place for that solution to be successful. And it includes proper onboarding. If you don't do proper onboarding, you're going to get hit with these basic questions all the time, and your engineers or your support's going to spend all their valuable time answering them. And in our case, it was very important that it weren't just the C-level employees that were on board, but also in particular the operational employees, because they would be the one using the software most. So that's the first learning. And the second one, which is a bit more oriented towards C-level, and this is a fascinating train of thought, and I hope this will stay with you. And I think about this all the time. The companies that we were working with, they view IT as a cost rather than as a value, a liability rather than as an asset. And it showed in the sense that not just the companies who we deployed the software for, but also whenever we do due diligence for a company, without exception almost. I mean, there are some exceptions, but 90% underspends on their IT, way less than what the rules of thumb are, and it shows, and it severely reduces their growth capability. And it showed in the way that we deployed our application network, and we were expecting these customers to put resources in and integrate with these new solutions, and none of them did. It shows that we often see companies select open source solutions rather than premium enterprise solutions. And yeah, the open source solution is cheaper, but I mean, in the same way that Linux is cheaper than Windows, if you now go start using Linux, you're going to lose 4 days trying to get the hang of it. And do you value your time? If you're picking an open source ERP or CRM or any other solution, you're going to need to hire software developers, expensive software developers, to maintain it. And so in the end, open source can be way more expensive than enterprise solutions, but most companies, they would just, oh, this open source solution is only $20,000. Let's pick it instead of the 100,000 enterprise one. And so our observation is that, particularly at a conference like this, we all talk about IT. I think everybody here understands the value of IT. Nobody's stupid, but the practice or the reality that we experienced is, in the end, it's still treated like a cost. And I would argue that's because there's this psychological phenomenon called what you see is all there is. And that's why I drew this picture on the right-hand side, made it myself in Microsoft Paint, amazing. You see the dollar figure, it's very salient of IT, but you don't really see all the hidden benefits that it may have. Like if you have to choose between two solutions, one is $100,000, one is $400,000. The fact that the $400,000 one makes you way more attractive to investors, allows you to access new markets and new products, and it's just more reliable. It's very difficult to put that in a number. Maybe you can measure reliability with uptime, but being more attractive to investors, difficult to pin down. And so whenever a decision on budget has to be made, people tend to pick the cheaper one, or it can be difficult to convince someone to put 10% of their operational revenue into hiring an IT guy instead of buying new stock. Hope I'm not going over time here. So one thought I would like to leave you all with, if you're a taxi driver, do you buy the cheapest taxi available for $5,000, or do you buy a BMW for $40,000? The real answer is it depends, but if you buy a BMW for $40,000 or $50,000, it's not necessarily a bad choice. It gives you more possibilities. You can drive, you can go to different neighborhoods, you can drive faster, it doesn't break down. And I would argue it's the same is true for IT infrastructure. It gives you so much more, and you should not just look about the cost. And so how do you solve this conundrum that C-level employees need to think more to IT, about IT as value? Well, we've pivoted our business, more consultancy services, less product development. So we believe you need someone with an IT background to be present during board meetings or to exert his influence on the IT strategy. So one thing we do is external audits. If you're a company struggling with IT, don't know which tool to use, then we do a technology assessment. But we also do this for investors that aren't sure whether a particular company can scale. We do a due diligence on the technology side. And actually, we're also doing like interim CTO. So we can help companies with their IT strategy. I'd like to leave it at that. There's a whole lot more if you want to read our blog, or if you're interested and want to chat, I'm always happy to help, and also tell a lot more about the off-grid solar or last mile distributor market. It's very fascinating. Yeah, thank you, Stanislava.
Thank you, Pim. I just want to ask you, of course, shares a lot of things, a lot of experience, but what is the experience of Enable Digital with the money, with the mobile money?
Yeah, thanks, Stanislava. I think that's a very interesting question. Mobile money in sub-Saharan Africa is such a critical component to, financial businesses. And I hope there are many people listening here right now that, are working with mobile money providers or are trying to integrate with them. So in our application network, we also try to integrate with mobile money providers. Our experience has been very challenging. It was very difficult, not from a technological standpoint. Actually, integrating with a mobile money provider is technologically very easy. But the paperwork that needs to be done can be immense. It can take 1, 2, 3 years from beginning to end before you're actually integrated. And then you're integrated with one mobile money provider in one country. It's important to realize that mobile money providers, even though Orange, all over Africa, there's Orange, but actually if you're integrated with Orange Uganda, that doesn't mean anything about integrating with Orange Kenya or anywhere else. So those are two totally different companies that just use the same brand name. We did have a hack. Actually, we found a particular Android app to work around this. If you're interested in hearing more about this hack, I'm very happy to share it. Just drop me an email. It will work. But yeah, thanks. Very fascinating question. And actually, maybe some other panelists would like to comment on this too.
Yes, actually, if you have time after Mr. Taye's speech, we can go back to the hacks and you can tell us more. Now we're going to proceed with Mr. Elias Taye. He's going to speak about the importance of central bank digital currencies. It's a post-pandemic COVID world. So Elias, you're in. You can tell something more about you and then about your topic. Thank you.
Yeah. Good day, everyone. I hope you're all keeping safe during this pandemic. My name is Elias Taye, and I'm a certified fintech professional and an international consultant in emerging technology and digital transformation. This year, I'm representing Lebanon as an international partner in the World Business Angel Investment Forum. It's a forum that is part of the G20 group, working towards a more inclusive world. So mainly everything fintech at many levels. Please allow me to thank the organizers of this Africa Digital Week 2021 and you, Stanislava. Thank you so much for the opportunity to be here among you. So the topic that we are going to address during this session is how important a central bank digital currency could be in a post-COVID-19 world. It's been a while. We have been hearing about central banks issuing or exploring issuing a digital currency. So what difference will it make? How and where, and what is it going to solve? Are CBDCs going to be the next norm in the post-COVID-19 world? So there are many valid questions that remain around the subject, and we can address those later in the Q&A session. I look forward for your participation, and I hope our session today brings a new perspective on the subject. Before I start tackling this, I would like to mention that I'm going to keep things simple. I know this is a very debatable subject. So the terms that I'm going to mention basically are not going to be specific. We are going to use the commonly known and widely accepted terms. Commonly known and widely accepted. For example, if we say central banks, this could be a Federal Reserve Bank in another country or other jurisdictions, so we'll stick to central banks. When we say digital currency, it could be a token, a stable coin, a value, whatever it is. So I hope you remain entertained at all times during this session. So yeah, we are going to talk about this phenomenal change in how currency is evolving. And we'll divide this subject into sections in a chronological order. We will talk very briefly about the emergence of fintech. Many of my peers already spoke lengthily on the subject, and they will still talk about it, but I will need to import that into the chronological order. Then we will talk about now the COVID-19 era, unfortunately, and later on the central bank digital currencies. This is the past, present, and future. This is somehow reflects how the digital economy and digital currency came into play and are evolving. So the introduction and later the surge of fintech services, solutions, platform, companies, organizations, the list goes on, call them whatever, cash cows and unicorns of the century. This fintech as an industry and as we know it today, and I mean by today, the post-2008-2009 financial crisis. Basically, it was aimed, it has a purpose that the world should work towards a more inclusive world, making a breakthrough towards financial inclusion. This is how things basically started, especially in Africa, later on Asia and South America. Not particularly in that order, but yeah. These are called disruptive innovations, but in fact, financial inclusion by definition and in concept is to allow as many people as possible to have access for finance. Probably in a non-traditional way is the best way to solve it, but that was the main purpose. Of our development goals in the 2030 Sustainable Development Goals set by the UNDP. It is featured as a target in 8 out of 17 goals. So yeah, this is something very important at an international scale. Out of 17 goals, target financial inclusion. This is basically, theoretically, is going to lead a sustainable world economy. This led later on to the digital inclusion, not just financial inclusion. And digital payments came on, electronic distribution, pens, tokens, contactless and cashless payments, microcredits, micro everything basically. So what happened after the crisis in 2008, 2009, there was some lack of trust in the standard financial system to a great extent in its ability, if not to say its willingness to serve the underserved and the marginalized. They didn't perform well. Fintechs presented themselves as a serious alternative. And they come up and presented themselves on the world market as we can help reach the unbanked, the underserved, the last mile client that nobody wants to serve. And it was at that point, basically, that the whole world started researching seriously the percentage of the unbanked populations, card penetrations, internet penetration, computer literacy, mobile, and later on smartphones penetration. There was huge efforts on trying to see how and what is the best way to do it, while fintechs were already doing what they do. So later on, 10, 11 years later, we faced this pandemic on a global scale, the COVID-19. So COVID-19 without doubt created urgency for all digital services, especially the financial services, but mainly anything digital. If we talk about distance learning, edutech, healthcare, work from home, using video conferencing, as we are doing now, anything technology. So the success stories are countless, but as the world is not perfect, there are ups and downs for everything. So this surge had a double-edged razor effect on some providers, especially in the fintech sector. And I would also say the clients of these fintechs. So many fintechs were unable to cope with it, unfortunately. Expectedly, probably, but this is debatable. Did anyone see that coming? Probably not. But this actually happened mainly because the money cycle was broken, especially that they had cash management difficulties, and at the client level, even when clients were able to provide cash, they couldn't reach the agent. And even in some cases, just like Pim just mentioned, because of exclusivity and lack of interoperability. So if you have a fintech that is working on a specific network and specific agents, and somebody else needs these services and they're on another network, they cannot basically use these services. People could not benefit from their digital money during this crisis, of course. So if we take the e-wallets, for example, take that in some countries, the credits and loans were disrupted because of job loss, because even people, like I said before, if they have cash, they couldn't go and pay. Payroll and retirement funds also became inaccessible, especially in Africa. So people were not able to pay on time, if at all, and the whole money cycle of the fintechs was broken. And those who did not have enough operating cash, they were not able to cope with the problem. I think basically this was due in essence to the fact that the fintech's ecosystem as a whole was built mainly taking into consideration that the banking system will still be there. Agents are open and operating, as I mentioned earlier. Cash in and cash out transactions are possible. Fintechs claim to disrupt the banking sector, but during this crisis, it appears like in a very transparent way that fintechs still rely too much on the banking sector. So to sum it up, during this COVID-19 crisis, which is still now, fintech is still becoming the new normal, okay? It's booming somewhere and failing somewhere, but still it is the new normal with its failures and successes, because some players have emerged stronger, like we mentioned in the examples, and some did not perform that well. We have been hearing about central banks wanting to issue, or they are exploring issuing, a central bank digital currency. So how is it relevant now in a post-COVID-19 world? Basically, what is a CBDC? A central digital bank currency is still a central bank currency, be it digital or not. So it's a claim in a digital form. It was used in many countries, not too much, but as a G2P payment, like the example of India, to release the relief funds. They use the Aadhaar national ID, the e-government system that they have in place, and because they have a complete ecosystem with infrastructure of banks, governments, fintechs, whatever, they were able to deliver this money from the government to the person, to the citizen. This is mainly, I'm trying to explain what a CBDC is and how it could be used. So, but before the crisis, actually, research has already started on how to digitize the global economy, because the technology now allows it. It's now feasible and somehow possible. Probably not in the entire world, in the entire globe, but remember, now we have faster computers, faster telecommunication means, 3G, 4G, and 5G is on the way. Open source operating systems, specifically on the mobile end, like the Android, for example. We have the distributed ledgers technology, DLT, which is very promising. So there was some kind of maturity, but not an urgency until COVID-19 came. Another example, even before that, household and firms have held digital money for a long time ago, in the form of digital money balances. So in addition to notes and coins, that is, banks have issued digital money in the form of demand deposits for decades. And central banks have done likewise, issuing reserves, but only to commercial banks. It's a two-tier system. Somehow it's elusive. But then the unicorns came in. So what has changed in the recent years, basically, is the ease with which users can access their money and spend it because of the emergence of fintechs. Fintechs and bintechs basically led the way, and banks have followed towards more transaction convenience. It could be worth mentioning here that cash use all over the world is declining. There are some different cases in some countries, which is normal, but cash use is declining. Cash is a central bank money too, but it's a fiat currency. But it's still a claim on a central bank. It's no longer fashionable, that's the whole story. But this is basically what attracted and increased the attractiveness of a central bank digital currency. This is one of the factors that helped speed up the research on a central bank digital currency before, during, and probably after the COVID-19. So when we talk about modern and fashionable, what is more fashionable today than a digital product? Everybody wants to go digital. Another factor we should not forget about is the emergence of cryptocurrencies, including blockchain, and between brackets, the threat that they pose on a global scale to the global economy. This is arguable, of course, it's not my personal opinion, but this is how it's being showcased, that cryptocurrencies and blockchain are a threat to the global scale and to the global economy. So we don't want to evaluate those, but this was a factor that led to researching central bank digital currencies and to offer something from the government that is more secure and people at least would feel safe using it.
And how do you think the CBDC is going to affect Africa? Let's
very interesting question. I think in Africa, you have a banking sector that is very diverse and very strong at the same time, but is not playing the role that it should play. Each country basically has his own legislations to start with, market conditions that might be different from other countries. But a central bank digital currency, basically, this is not something that is going to happen tomorrow. So the banks in Africa, they have to transform their mindset at the beginning, once the legislation is there, of course, to try to maintain that relationship with the central bank and not just leave space for the fintechs, which probably they can fill. I'm not arguing about that, to do that. So they will get the chance to do some change on a continent level. That's how I think, because the way basically a central bank digital currency is formed in essence and to serve what purpose will define how and what it is going to serve. But in all cases, banks are best positioned to serve that purpose if they want to, if they decide to cope with this change. I can give you many examples about that subject, but at the end of the day, it's a political matter. The legislations have to be there, and the algorithm of the central bank digital currency has to be clear on what is the purpose that is going to serve and how. And then the remaining tasks or effort or even investments are just details. I mean, if you see how fintech has evolved in the world with personal initiatives, and then now it's attracting billions of dollars, I don't see why banks cannot benefit from that as well, and why they cannot position themselves on the forefront of this effort. They should, they can.
Thank you, Elias. Thank you. And we have one more question. What and how is the importance of CBDC is the post-COVID-19 world? I believe you answered that with a few sentences before, but you can summarize it.
Well, yeah, this is going to change basically the whole digital economy on a global scale. You can, of course, put it on a continent scale, because every continent has its own conditions. Even every country in the continent has its own condition. But basically, when you have some kind of a digital currency that can be exchanged instantly, and that it can provide security on a global scale, and it can be delivered at a very low cost through a channel of banks and fintechs to the last mile citizen of the world, this is going to be huge. Many people, especially in Africa, are unbanked, like the peers in this session have mentioned before. So it's not that hard basically to reach them if there is will. Instead of catching our ears like this, with national effort, like India did, for example, it can be done. And it can be done at a very low cost with so much value at the end of the day.
Thank you. And sorry, but we are running out of time. Pim, we are not going to get back to you with the hacks, but we can chat and we can discuss it in another meeting. I want to thank all of the speakers in the Fintech and Digital Banking Innovation Conference, Blockchain and Crypto Finance. It was a great pleasure for us to have you here. I want to thank the participants of the conference. I hope they enjoyed the webinars as much as we do. Once again, special thanks to our sponsor, TimeDix, our diamond sponsor, Tendric, and our platinum sponsor, Trinity Technologies and EM Gurush. Thanks to all of the supporting organizations that make us more than welcome here in Africa. At least, but not last, of course, I want to thank the whole Digital 4 team and the whole worldwide volunteer team. The program of the conference, we're going to continue with the video stream. You can find it on the main site of the event, and we will meet again, of course, in the next Digital African Week in 2022. Also, you can join us in Asian Digital Week, which is going to be held in April 2021. Check our website, worlddigitalweeks.com, and you can see the other events. And tomorrow we're going to continue with the Green Energy and Smart City Digital Transformation Forum, here live streaming on Zoom. And have a great day to all of you. And thank you and best of luck once again. Thank you.
Thanks.
Thank
Goodbye.
you. Thank you.
Bye.